This is Make It Simple by FSDH, where we simplify everything business and money.
Well, I guess one of the most important topics on everybody's mouth now, from individuals, SMEs to corporates, even government, is the issue of tax reforms. And for me, I think it's a step in the right direction, especially when you look at what this current administration has been doing in terms of monetary policies. And now the fiscal policies, part of the government has to shake hands with monetary policies. And I think one of that first step is the tax reform, especially when we've seen that Nigeria has one of the lowest tax-to-GDP ratios in the world. I was looking at it prior to 2021. It was about 5 to 6%, which has gone about to 10% now. And with this current policy, tax reform, they're looking to take it to 18%. What do you think?
Yes, I agree with you, Kunle. And I think if you look at the legislation that has been drafted, it's actually a landmark legislation, which is of world-class standard. And I think this shows a bold shift towards modernizing the tax administration in Nigeria, broadening the tax base, and obviously aligning Nigerian tax system to global best practices. Is essentially targeted at ensuring consolidation and simplification of the existing tax framework, most of which are outdated. And there were several individual tax laws that were sort of consolidated into one single legislation. It has upsides and downsides. There are upsides that are beneficial to both individuals and corporates, and there are some areas where there is need for organizations to look at it, understand the changes, how it will impact them, and be able to implement that.
And exactly that's what we're doing here today. You understand, to see how that would affect both organizations, SMEs, just to provide some clarity around it. These things are written in simple English words that would help us. And I like the point where you talked about even the issue about simplification. I was looking at that law, and I found out that they are actually consolidating over 50 different laws, acts, and all that. How do you work with 50? And especially, I know you guys from the financial control part of things, are working on, 50 laws are consolidated into 4. And also, we know that things are quite hard, difficult for people now. And just before we started, we were talking about let the poor breathe, just ensuring that some people are not in the tax net, and how we can ensure that the tax net is also broadened. I think just before we go on, I think maybe you might want to highlight some of the major changes. I think if we look at individuals, I know that for individuals now, if you earn 800,000 naira and below, you don't pay tax. I know for corporate organizations, I know that tax rates has SMEs. If your turnover is below 100 million and assets below 250 million, maybe you don't pay tax. For corporate organizations, the CGT has increased to 30%. I think multiple, but at least even for corporate organizations looking for ways in which they would reduce the corporate tax from about 30%, I think initially, to about 27.5 and maybe 25% subsequently. So what are your views on that?
Okay, thank you very much. And I think in the way I will approach it, I would like to speak to the upside and the downsides, because there are different narratives depending on people's understanding of the act and how it's being interpreted. I think I will maybe sort of rather start from the upside. Now, in terms of the upside and implication of this, and you mentioned one of it, small companies, are going to be exempted completely from taxes, which means zero tax. And that definition is actually, like you said, organizations with turnover above 100 million and, total assets that is actually way below 250 million. But I think one cautionary note I will put there is that for this particular definition, there are like two different figures out there in terms of legislation. Today, small businesses are businesses with 25 million turnover. Correct. So one of the legislations in circulation has 50 million, which effectively means a double of that 25 million. There are some that is also carrying 100 million, which is times 4. But by and large, one thing that is clear is, like I've said, the legislation has not been gazetted, and when the gazette comes out, there will be clarity around what the final figures are. But what it basically means is that SMEs that are forced into this category are actually going to, have to be paying zero taxes going forward on the back of this legislation. The second, in terms of upside, I'm also going to speak about is even though capital gains tax have been increased from 10% to 30%. Two things is that the proportion of overall tax payment by corporate that relates to capital gains might not be so significant, except for when there is divestment of equity interest and all that. But that said, for assets and other, chargeable gains, there is a provision to be able to net any chargeable loss within that period with the chargeable gains. And once you're able to do that, it's just the net that will be paid. And if eventually the net sums up to zero, then it means you don't have to pay capital gains.
But on the issue of this capital gains tax, what is your view on investments coming into Nigeria? Because I hear that 30% was probably maybe the highest in West Africa. What is your view? Do you think that it will attract investments to come into our space, or people would say at 30%, if I dispose after 12 months, and it gives us a list of assets that are going to attract capital gains, even the shares you must hold for a certain period. Do you think when people review that, they would want to continue to invest in our client?
I think the first thing I will say is, because capital gains is existing currently, it's basically just an increase of the rate from the former rate of 10 to 30. And I've also said that because there's a clause that allows, chargeable losses to be net off, that provides some, But then there is another clause that essentially says that when this disposal happens, if the proceed is reinvested in the economy, correct, that proceed, then that portion or proportion will be excluded from capital gains tax. So meaning investors that are coming to play long term in the country are actually still, encouraged to come in and be able to play that. And in terms of threshold for the CGT on shares, like you rightly said, it's when you trade total turnover above 150 million and chargeable gains is more than 10 million. Now, still speaking about investment, even though on the one hand, that's actually maybe higher taxes, but I think really it sort of, encourages long-term, play within the economy. But outside that, another flip side for upside of that is that for companies that are coming in for, mergers and acquisition and business combinations, right, yeah, there's actually an upside, which is to say that the previous deferral period of 365 days to be able to leverage the tax advantage that exists in the business combinations, basically, which might be unutilized, deferred tax assets, probably credit notes that have not been used or carryover losses. Currently, it can be utilized immediately, which is actually, a sort of positive incentive. In terms of, free trade zone also, there are some changes in the way, the operations there will happen. But if you look at changes to the free trade zone rule, essentially, there is the requirement that, every export that goes out from free trade zone will still be 100% non-taxable. There will be zero taxes on that. But there's a clause around when you sell to what is called custom territory. And the cap there is now that 25% sale to custom territory is going to be, taxed. If you do above 25%, you are going to get taxed for that portion that you've sold to custom territory. But that extension is just for the next, I think, about 2-3 years till 1st of January 2028, after which any sales at all to custom territory will obviously be taxed. But I think, still speaking about, some of the upside, there is actually an economic development incentive that has come in to actually replace pioneer status.
Yes.
And what that says is that for capital investment, or what's called qualified capital, investment, there's actually going to be 5%, incentive on that. And there is, a provision to carry it for the first 5 years, and there can be extension for another 5 years, on that. We know withholding tax rates have, reduced, basically, so to say. So, for individuals, like you've said, I think it's mixed in the sense that individuals who are within certain income threshold, like 800,000 and below, are actually going to pay zero taxes. But because it's a progressive tax rate, people that earn much more, actually,
up to, and I think it's up to 25%.
Exactly.
That they have to pay.
They will have to pay.
But I think let's go back to that. What's it called? EDI, the incentive, whereby, and I think one of the things government is trying to do, especially for that incentive, would be that there are some strategic sectors in the economy that the government is looking at. Sectors like green energy, sectors like agriculture, even IT space, payment space, and all that. I think that's such an incentive for some of these companies to come and set up here because of some of those incentives that they will get. I know in the past there used to be the pioneer status for these taxes, but at least everything is consolidated now. They know what they're getting into. And one of the things is that if there's a company out there, you are doing green energy, you are doing agri and all that, you see that government is much more interested in this, it gives you that incentive. You can start looking at your business and say, okay, rather than the cost side of things that people are always looking at when it comes to tax, or it's a cost and all that, you can also start looking at the opportunities where these incentives come in, and even concessionary funding for some of the corporates in that sector, and that they are now dealing with multiple taxes. Because I used to understand that for especially for financial institutions like ours, you pay the corporate tax, you pay the education tax, you pay, there's so many of these taxes that you're paying. Then even for government itself, one of the things that you start to see is that apart from non-oil taxes, because yes, they got a lot of taxes, petroleum profit tax and all that on oil taxes, but from non-oil revenues, they can start getting other taxes. And when you start getting taxes, tax to GDP has reduced. Money for social spending, for development, also increases. So I think all in all, they've kind of looked at all the different parts of the law, all the different parts of the taxes. Is it perfect? No, but I also now want you to talk about, because one of the things is that if tax rates are too high, people will start to evade it, But now that we have tax, it's more transparent, rather than evade. What do you see about compliance to these taxes?
There is upsides that organizations and individuals have to look at and obviously take advantage of as it comes up, but there are also downsides. But in terms of compliance, I think, especially from the perspective of financial institution, government is trying to drive a couple of changes around the way they approach disclosures, and I will mention a few of that, maybe about 3 of that. First, we know that tax identification number is required by banks to provide for their customers and all that. But currently, financial institutions that are required to provide that has been expanded to include, for example, insurance companies and stockbrokers, because most of the sale of share transactions we are talking about will happen with the stockbrokers. So they also have to now have TIN for this transaction and be able to, demonstrate that to the new Nigerian Revenue Service. In addition to that, there is threshold for transaction reporting within bank, where transactions above a particular certain goes to STR. But now for this 25 million. Yes. But now for the stockbrokers and for the insurance company and other financial institutions also, they obviously have to do similar reporting now. to actually, provide more information for the tax authorities to be able to track, individual flows and transactions and make sure they are able to bring it into the tax bracket. In addition to that, there's some more granular information disclosure requirements around individuals, both resident and non-resident, that is required now. And the fourth is, of course, we all know that digital assets have actually been onboarded,
like cryptocurrencies,
cryptocurrencies and all that. And it's also showing the fact that this new law takes into cognizance the current age and time, which we are in, technology and AI age. So there is a focus to ensure that the new industries, the new technology and the new businesses that have crept up, which were not included in the tax base all along in the old laws, are actually included in this current legislation. And the good thing is, SEC has already, actually enacted the new Investment Securities Act 2025, which was signed sometimes in May. So now there is a need for, entities that are involved in custody, exchange, or management of all those virtual assets and cryptos to actually, come under the tax bracket and report those transactions and pay taxes. And there are very stiff penalties for non-compliance now.
Yeah.
So I think the summary of what the government is trying to do is to, make it more costly not to comply in terms of penalties and implications. But there are instances where, rates of taxes were looked at. You mentioned the corporate tax. I think in the current legislation, there is a provision for the president to be able to, be able to sign off a reduction in the absolute tax rate from, say, 30 to 25. I think if the committee, the tax reform committee and NRS are able to achieve this before 1st of January 2026, that would be good, because like you said, the 30% corporate tax rate still seems high. And we believe that when that happens, same will be applied to the capital gains tax, because basically the capital gains tax seems to sort of align with corporate tax rate, so that there's no tax arbitrage in between this. So looking at the information gathering that the government is looking to do, the clarity in the law and what they are trying to do in terms of implementation, I think there will be better, coordination and ability to actually drive compliance for these tax laws. Yeah.
And in driving compliance, I think more would be, can the government set up online systems, IT systems to drive compliance, which means that they can plug into your system, plug into my system, plug into everybody's system, and you can link transactions done. So if I do a transaction with you, you do a transaction with somebody else, that person does a transaction, and maybe it's the same transaction, you can link everything together and ensure that you are not owing government or evading tax or playing any games. But I think all in all, it's more like there's no hiding place for anybody anymore. And it also means that, from when I look at it, there's a lot more information that if, for instance, we're doing a credit for a client and all that, much more information that we can have access to, much more granular information. It helps you to take decisions better, give you better decision making. And, all in all, I think for me, it's a good law. And since they've talked on individuals, to SMEs and MSMEs, to large corporations, who else is in that law? I mean, everybody is included and captured in that law. So I think for organizations, one of the things they need to start to do is start to review those laws properly, so that you don't fall foul of the law, and start to say, where does this really affect us? How do we work within the ambits of the law when it comes to these tax laws? Because it's all new, and because it's really all new now, how do we work through it? Or what do you say?
Yes, absolutely. And I think for a couple of organizations, the first step is to, make sure they get hold of the gazetted copy, like I've said, because that's going to then show maybe some changes that would have happened between the bill people are seeing online and, possible amendments that would have happened at National Assembly, and how that is then subsequently indexed and actually incorporated. But I think once that has been done for organizations, then there will be a need to actually, do what's called a business impact assessment and analysis. There will obviously be opportunities, within the ambit of these changes to the tax rules. And of course, in terms of, tax planning also, of course, there will be a couple of opportunities, but I think there is a need to sort of relook business models,
Correct.
Look at the way the organizations are structured, and then be able to, be able to ensure compliance with this tax law while avoiding any form of evasion. And in saying that, it's going to have different impacts for different organizations.
Correct.
So, for example, because the effective date of the law is expected to be 1st of January 2026,
yeah.
and tax laws are not expected to be applied retrospectively. What it means is between now and end of the year, the government have given corporates and individuals and stakeholders 6 months to plan and comply with the tax law. So if there are probably organizations that are looking to quickly do maybe share divestments and all that, between now and 31st December, they will obviously still be paying CGT at the rate of 10%. The other is to even look at the fact that the new Tax Act has redefined what is a Nigerian company. So originally under the old law, a Nigerian company is deemed as a company that is incorporated in Nigeria. But now there is a clause that if the company is actually centrally or effectively managed or controlled from Nigeria, meaning if strategic decision making and the key strategic decision maker sits in Nigeria, is going to be deemed a Nigerian company, irrespective of whether it has foreign subsidiaries or foreign operations. Correct. And that also have a couple of implications from a tax perspective. One of the implications is on distributed profits. Correct. So if those foreign subsidiaries make some profit that were not distributed as dividend to the parent company in Nigeria, to the extent that the tax authorities can ascertain that, look, based on their judgment, declaration of those profits wouldn't have affected the business operations or their liquidity, that profit is going to be deemed as distributed. Correct. And it will be taxed in Nigeria.
I think there's some 15%.
15% minimum tax. Correct. So that's basically that.
And I think that is based on globally accepted standards.
Yes.
And that happens. But, I think we can go on and on this tax reform. One of the things, at least both of us have agreed, is that it's a step in the right direction. The tax law is forward-thinking, and it affects everyone. And there's a quote I think that's attributed to, I think, is it Benjamin Franklin, that the only certain things in life are death and taxes. And so I think for us is there are our clients out there who may be looking at, okay, what does this mean and all that, and for them we're available to help them look at it. Yes, they may still need to get their tax consultants to work on it, and once that is done, then everybody make sure you pay your taxes so you don't fall foul of the law. Well, I think on that note, we should bring this to an end. I hope we've been able to put some clarity around the new tax reforms. We may not have been able to do everything line by line because, like Seun said earlier, it's still being gazetted. But for every individual, every company out there, we need to be responsible citizens of our nation, Nigeria, and ensure that at the end of the day, we work with the current government in ensuring that we pay our taxes and ensure that things are done properly. Any last words from you?
Yes, like I've said, I think it's a significant piece of legislation from the government, and this seeks to consolidate and simplify the existing tax framework. Kudos to the government. This is a bold move, and it's an addition to the several bold reforms we've been seeing. The goal is just to have, compliance, because the cost of non-compliance now is actually
very high,
a bit more expensive. And in summary, I think on a lighter note, it's basically just saying that this legislation effectively, is designed to, relieve low-income earners and small companies, which is more like saying, let them breathe, But I mean, from the perspective of letting them breathe, there is then a balance in the book or a gap that needs to be covered. And I think, let me say the middle class and the richer individuals plus the bigger companies and corporates are going to fill in the gap. So thank you.
Like somebody like you. All right. Thank you for watching. All right.
Thank you.
This is Make It Simple by FSDH, where we simplify everything business and money.